Hello, and welcome to my final project for my Applied Business Analytics class. I have chosen to do a presentation on forecasting, and I have thoroughly enjoyed this class. I've enjoyed what I've learned. I've enjoyed the information. I have been a financial analyst for the past 5 years and have forecasted myself, and it's been interesting learning the different ways and types, and that there's almost all of this was brand new to me. I didn't know a lot of the information in this class. So to me, this class has been fantastic, and I hope you enjoy this presentation. Business forecasting makes the world go round. This is accurate in my opinion. When I looked through and started learning about the different types of forecasts that we had, it was much more than just business forecasting. We have weather forecasting, we have supply chain forecasting, there's stocks forecasting, there's risk forecasting, there's forecasts all over the place that we don't really pay attention to, but that definitely exist. Business forecasting involves making informed guesses about certain business metrics, regardless of whether they reflect the specifics of a business, such as sales growth or predictions for the economy as a whole. That was a quote out of Investopedia. Forecasting is all around us, and almost all that we do, from the weather app we check to the coffee we start the day off. Most things around us require forecasting. To be honest, this next part was an eye-opener to me. I had never thought about forecasting going back to hunters and gatherers, early humans from hundreds, if not thousands of years ago. When they prepared for the winter, they would have needed to plan out how many people they had to prepare for, and would have needed to figure how much food and water they would have needed to stay safe and alive and keep warm. Everything that they did they would need to forecast. And it's not something that I thought about, but once it was acknowledged and my eyes kind of opened to it, it was a super interesting thought of not only do we forecast all day, every day in our business, but humans have been forecasting basically since the dawn of time. Like it has always been needed. So it was an interesting thing to think about. Ancient Mesopotamia was one that I was able to find a lot of information on. It's the Middle East as we know it today, but there were many different things that they had figured out and created, from mathematics, which once they had started down that path, it led to many others. The people of ancient Mesopotamia looked to the sky to understand their physical environment. Mathematic innovations helped them chart and map the daily movement of the planets and stars, which allowed them to track the passage of time with a 12-month calendar and a pattern of changing seasons, all of which is still used today. Astrological observations could also predict the best seasons for sowing and reaping crops, and that was a quote, and my sources will be listed at the end, but you can see this picture here, and this is this is one of the calendars that they had come up with, and it was pretty fantastic to be able to figure out, with the technology that they had, and their understanding of mathematics was really unbelievable. We think in modern mathematics, and so it was really kind of interesting to figure out what they had figured out, thousands of years ago, and then to be able to understand the seasons, and that would be forecasting. They would have timed the seasons to when was most optimal to grow crops, and when was most optimal based on the seasons to provide for all of their people. So this was forecasting started a long time ago, and the metrics have gotten better and the methods have gotten better through time. But even thousands of years ago, there were still wonderful methods for predicting and trying to forecast what would be happening in the future, so they could plan and prepare for it. From ancient times, that takes us to more modern times. We go from basically the Industrial Revolution. There was a man by the name of William Stanley Jevons in 1865. He argued that manufacturing replaced agriculture as the dominant sector in English society. He studied the effects of economic fluctuations of the limiting factors of coal production on economic development, and that was out of the Encyclopedia of Business and Finance. In a Q&A article, this article is really interesting because there's a writer named Sean Silverthorne. He interviewed Walter Friedman, who wrote a book called Fortune Tellers, which was really about the early turn of the century business forecasters and trying to understand how they failed to see the Great Depression coming. The late 19th and early 20th centuries were a period of severe panics from 1873, 1893, 1907, 1920. These people had lived through ups and downs. I mean, you can go back and see the crashes that would have happened and some of the economic struggles that existed. And so predicting these things became very important. And forecasting at this point was sort of a relief. But there had been many periods with severe panics throughout the more modern economies at this time, and forecasting was basically considered an idea or a comfort to those that had lived through it. This really led me to find this person, Roger Babson. He lived from 1875 to 1967. Forecasting, it was an ancient art that had always been part of commerce. Beginning in the late 19th century, forecasting methods became more scientific. Roger Babson was one of the pioneers of this transition. He collected a range of data, including bank clearings, immigration numbers, commodity prices, railroad earnings, and other information, and combined them to form the Babson chart, which offered predictions of future booms and busts. By the 1920s, Babson was mailing out forecasts to businessmen and investors around the globe. Not as sophisticated as his competitors at Harvard and Yale, he nonetheless popularized the industry, and also, unlike them, correctly predicted the 1929 crash. The story of his forecast reveals how his long-standing commercial ambitions, like the desire to predict the future, became incorporated into managerial capitalism with its quest for rational efficiency at the start of the 20th century. It was, in my opinion, though there were schools doing what he was doing in taking the analytics and looking at different sectors of different businesses and putting them into a graph, I feel like he was ahead of his time. And like it said, he correctly predicted the 1929 crash. This chart that you're looking at, I found in several different spots. And the more that I studied this chart, the more fascinated by it I became. If you look in the top left corner, it gives an explanation. It's very difficult to read, so I'll read it to you. The vertical red lines show the monthly range of averages of 40 stocks, 20 rails, and 20 industrials. Use scale figures under 1923. You can see if you don't go down the column of 1923, it will give you a stock scale, and you can see the numbers kind of in red. The dotted red line is a record of the average yield of 20 active bonds. The red figures under 1921 refer to this line. The last question before going to the press, the dotted black line is a record of the average wholesale price of 29 commodities, excluding food stocks. So the more that I looked at this, the more I was fascinated by it, and it begs the question: why didn't they understand? Why didn't they figure out the crash of the 1929 market crash? Why weren't they more aware of it? It seems like there were factors and things that people were looking at. When you just look at this graph, you can see the dance back and forth, and the stocks really going from so far below from 7 years before, if you look in 1921, to almost off the chart in 1929. There were a lot of tells, and this chart that he created to me was really impressive, fantastic, graphical, and to put this together, in my opinion, I think this guy was ahead of his time. But this was a great indicator, and he had predicted it was coming, and nobody listened, and that's how it goes sometimes. We can easily see the effects of the Great Depression. The left chart is Dow Jones Industrial Average. You can see what it went from and what it went to, quite the decline. And then more importantly, the unemployment rates, in my opinion, were much more indicative of how hard the times were, going from under 5% going to over 20%. And we're all familiar with how hard it was. Many articles point out many different advantages and benefits of forecasting in business. Forecasting is an essential part of business planning, budgeting, operations, and funding. Every single aspect of any business would need to be forecasted. Manufacturing would need to know how much product to make based on what they thought would be sold. Of course, it isn't magic, but having some kind of calculation is much better than none. Inventory kept at levels to meet demand is how a business will stay in business. Too few or too much inventory will kill a business either way. Operational management was largely affected during COVID. I worked for a food company and our supply chain took hit after hit. Getting product to where it needed to be was incredibly difficult. The plants couldn't get enough people to get the amount of product through the lines. There weren't enough drivers to get the product to distributors. Customers were buying in completely different patterns. It was a mess. Our forecasting methods changed due to the effects of COVID, but forecasting was imperative to find success through the market change. Forecasting helps you manage your business operations in the best way. Budgeting and cash flow will depend on the financial forecasts. Companies need to accurately forecast revenue and expenses to understand their cash flow. It can alert you to periods when you can expect an increase in sales and organize additional staffing ahead of time. Emerging trends and customer preferences should be noted as well. A marketing forecast helps businesses conduct trend analysis by predicting future market sales data and the growth rate within sector. Another beneficial area of forecasting is risk management. Everything in life has some sort of risk. Business ventures are incredibly risky. Often companies hedge themselves against things like changing markets, inflation, interest rates, and customer changes, among others. Risk forecasting can help you predict and prepare for risks. Both those that are obvious and unlikely are obvious and likely, and the unlikely are unforeseen. Every single aspect of business really needs forecasting. Whether your business is big or small, it is necessary. There are many ethical concerns and issues related to forecasting. I'm going to go through a few: data privacy, bias, transparency, and over-reliance. Companies collect data in many different ways. The collection of the data is only one part. The protection of the data is another. The negative consequences of disclosure include risks of unauthorized access. Data security protects data from compromise by external attackers and malicious insiders, whereas data privacy governs how that data is collected, shared, and used. In forecasting, bias occurs when there is a consistent difference between actual sales and the forecast, which may be of over or under forecasting. Companies often measure it with mean percentage error. If it is positive, bias is downward, meaning the company has a tendency to under forecast. If it is negative, the company has a tendency to over forecast. And this cartoon that you see here is a Dilbert, and it cracked me up. Your analysis does not conform to my preconceived notions. So my gut instinct is telling me that you are wrong. When your gut talks to you, what does it use for mouth? We see this all the time. The data doesn't exactly sound what I thought, so the data must be wrong. Just kind of funny. With transparency and methods in use, a Truvada survey found that 60% of customers are uneasy with companies using their data for analytics. Some 74% are also nervous about their personal details being sold to third parties. And 65% say they are more likely to be loyal to a company if they trust them to use personal data. Consumers are aware their data is being used by companies, and statistics tell us they are not comfortable with the use of their data. Companies need to let consumers know they will be using their data and reassure them they are acting honestly and ethically with the data. I believe this honesty will build trust between companies and consumers. Forecasting, no matter how sophisticated the calculations are, is still an educated guess. Software, AI, or any other tool need to be a guide to human judgment rather than a replacement. I believe human bias is as potentially faulty as miscalculation. The analytics really should be an aid or guide to forecasters. I had mentioned our volume variances through COVID, but the reality of that time was human intervention, and interaction was the only reason we made it through in a better situation. It took thinking outside of the box. We couldn't just look at historical, seasonal, cyclical trends and rely on the forecast. We had to make sure manual adjustments, because the software had never seen conditions like that existed. We had to make the best of many bad situations to put the company in a stronger position. It was a scary time, but it was a great time to see people come together and work as a team. It was really kind of fantastic. When we look to the biblical perspective of addressing forecasting issues, I feel like the sharing or selling of data is no different than this verse. He that goeth about as a table-bearer revealeth secrets. Therefore meddle not with him that flattereth with his lips. How can we reconcile the sharing or selling of data without being a gossiper? We can be honest with those whom we do business with. Being upfront and honest will likely get us less data, but there will be much less pushback on those to take part or sharing in information. Christ never served two masters. Mark 12:13 through 17 is one of my favorite stories. It's repeated thrice in between the Gospels. The Pharisees are trying to catch Christ in a trap, honoring Caesar over God, and asked him if it was lawful to give tribute to Caesar or not. Christ said to them in verse 15, "Bring me a penny, that I may see it." Verse 16, whose is this image and subscription? And they said unto him, Caesar's. Verse 17, and Jesus answering said unto them, Render to Caesar the things that are Caesar's, and to God the things that are God. And they marveled at him. There was no bias, there was no disrespect to God the Father, nor disrespect to Caesar and the law of the land. Bias in data is dangerous and leads to waste. In conclusion, running a business can be extremely complex. It always starts with an idea, but many things are needed for it to run efficiently. Capital, human capital, operations, supply chain, market variabilities, debt variances, along with many others make running a small or large business quite scary. Forecasting is needed for almost all functions of a business. Successful businesses forecast incredibly accurate. In this class, we've been taught the differences in forecasting models, whether it be qualitative or quantitative. We've been given tools to make judgments about business decisions. The reality is all these tools, including the emergence of AI forecasting, will always need human intervention. That may change, but for now it's accurate. People that have the intuition to look past and present data and understand certain market conditions might change the demand or need so drastically that the manual adjustments need to be made. COVID was a perfect example of this. No computer analytics software could have predicted what happened to the world during COVID. This is why our education is necessary, to be able to jump in and make adjustments where needed. Thank you.